So let's go back to our Frank situation. Now we have Frank who had $250 million of real estate. Let's say he set up an LLC just for ease of administration and and liability protection to run the thing. Decreased in value just because of the economy down to $150 million. Let's say Frank sets up a generation-skipping Grantor Trust.
Now, Scott, what's a Grantor Trust?
A Grantor Trust is a trust where, even though you will make transfers, either by sale or gift, that will be considered completed gifts and transfers for estate and gift tax purposes, for income tax purposes, it will be considered as if you've never transferred the property.
So it's a completed transaction for gift and legal purposes, but for income tax purposes, it's as if nothing happened.
That's correct. By putting in certain retained rights for yourself as the grantor in the trust, that's what creates this, sort of apparent inconsistency, but as we'll see, creates tremendous opportunities for us in the context of the estate planning. The advantage of making these gifts and transfers, in effect, is you're trying to freeze value today. And by using this Grantor Trust, which is an incredible mechanism, in effect, the grantor, Frank in our example, is paying the taxes on all this income. So in effect, it's like an additional tax-free gift, and that can happen for the rest of Frank's life. In addition, because it's a Grantor Trust, there's no tax on the sale. There's no gain generated at the initial time of the sale. So you have a lot of very powerful mechanisms in here. So now we're sitting here with, on a discounted basis, we have $150 million of depressed asset value. And let's say we want to go ahead and transfer 49% of it, a minority interest, which is worth about $75 million undiscounted. Because we've transferred this discounted interest, if the structure of the sale or gift is set up properly, we can take discounts of, let's say, between 30 and 50%.
That's a pretty powerful figure.
Absolutely. But based on what's in the current law, if the structure is set up properly and we really are gifting or selling a minority interest, these discounts are perfectly acceptable.
But you do have to go out and get an appraisal for the property and a subsequent appraisal for the actual interest that's being transferred as well.
Absolutely. It's very important that the structure and everything else is set up properly. It has to be set up as you would with any other normal business transaction.
Formalities here do really count for things. The failure to sort of follow the formalities could sink the whole transaction. And as an aside, I'd also point out a 49% interest avoids a transaction that would create a transfer tax as well.
Absolutely. Also a very important point. So the 49% interest in the LLC would be valued undiscounted at about $75 million. Now, let's go through the potential for discounts. We had said that if we sell or gift a minority interest, our 49%, that we could take discounts. And let's say the discounts would be between a 30 and a 50% range. So let's say in our example, we settle on a 40% discount. So for gift and estate tax purposes, what would have been a $75 million transfer at a 40% discount would become $45 million for estate and gift tax purposes.
So that's $45 million of transferred value, which in reality has a fair market value of $75 million, and that's on a depressed basis could in fact be worth $125 million.
That's correct.
That's pretty powerful leverage.
Yep, it sure is.
And it's probably harder to find a better investment at this point than a transaction like this that would create this type of savings over time.
No, absolutely. And as you and I know, when we work with clients and implemented transactions just like this, if you go in and you take a look at the client's portfolio and you pick out the assets that have the best potential to appreciate over time and the ones that are generating the most cash flow, you can sort of cherry pick which assets make the most sense and have the most potential to really take advantage of what's presented to us by the economics of the situation and the tax law.
our favorite kind of assets are the assets we sometimes call exploding assets, where they might have a very low value today, but because of certain market factors or things that might be present in the future, have the ability to explode into, you know, enormous amounts of value later on.
No, absolutely. When you're doing any of these transactions, all you're really doing is you're taking a look at the client's portfolio of assets, like you say, picking out the best assets, and then just taking advantage of what's given to us, whether it's in the law or the economy, the low interest rates. It's just a matter of creatively taking a look at what's there, and by setting it up today and doing the gifts and sales that we're going to talk about now, just by locking them in today, we have the potential for this explosion in tax savings and increased value going to children and grandchildren.